Welcome back to another edition of Higher Education Today. I'm your host, Steven Roy Goodman. Today we're going to be speaking about personal finance and the importance of personal finance, particularly to young adults and for young adults. We have two guests today. Alex Barron, who is the author of a book called Counting on Yourself, and Bobbi Kurshan, who is the author of a book called InnovateHERs. Welcome to both of you.
Thank you.
Thank you.
I should probably say, first of all, that you guys are more than just authors, even though being an author is significant. But in the course of this conversation, we'll cover many of the things that you do as well. But let's first start talking with you, Alex, about your book and about the intersection between personal finance and math. That's what your book is about.
That's right. I wrote the book because I found that students and also young adults are really trying to figure out how to navigate a financial future and often don't have the prerequisite mathematical skills to set them up to be successful. As an educator, I find that many students go through their mathematical progression not understanding why they're learning math. And I think we as educators often could do a better job applying the math that we ask them to learn to a skill that every single person needs, which is managing and planning for a financial future. And so the book really aims to simplify mathematical concepts all the way from kindergarten through 12th grade and apply every example to personal finance so that people who are starting on their personal journey can be successful in finance and learn math at the same time.
And you're also a middle school principal, so how do you do that for students who are in middle school?
That's the question. The fascinating part about middle school math and going forward is that elementary school and middle school, you're learning concepts that seem elementary, but actually set the foundation for all types of sophisticated concepts students need for the future. So for example, in 6th grade, you start learning about linear and proportional relationships, which is for every hour I work, I get $7 more. And that sets you up for linear functions later, and then later for compound interest and exponential functions after that. So it's actually the work that we start doing in elementary and middle school that really is foundational for personal finance concepts.
Fair enough. And Bobbi, you are, in addition to being an author, are also a well-known education entrepreneur. Can you say a word or two about how some of these relatively simple concepts that young students are learning, how that helps them when they're on their journey later on?
Well, it goes way back in my interest, having been a math teacher in my first career, and then a computer science, one of the very early people to get a degree in computer science and instructional design, PhD. I understood that to become an entrepreneur, you needed these math skills. And I can't tell you how many entrepreneurs ask me, one, what the difference between an investment bank and a commercial bank is. Two, they have no understanding of how to do valuation and what that means. It's a simple ratio, proportion, money in, the value of your company. So these principles are really important to entrepreneurs. I'm currently running an incubator at Hopkins for health entrepreneurs and startups, and they are taking a class that we added this year called Finance in the Age of AI for Entrepreneurs. It's being taught by a wonderful entrepreneur that I had worked with when he was starting his first company, who became very involved in the Bitcoin. They have no understanding of Bitcoin stocks, and all of these basic principles that they didn't learn when they studied math are applying now to the financial background of becoming an entrepreneur. So there's a direct connection between the skill set that Alex is talking about and the skill set that we want our entrepreneurs to apply when they're running a startup.
But what about a student who is graduating from college XYZ who may not have studied math and they want to get involved in something innovative and entrepreneurial? What should they do?
Well, the first thing we do is ask our students to find a class to how to use a spreadsheet. You can't run a startup unless you could create a spreadsheet to give to your investors. And a spreadsheet is sort of the basic introduction, because it's basically a matrix that Alex talks about in his book. They're basically learning to do mathematics as they're building a financial model. And we make them take a prerequisite class to come into our entrepreneur, and they can take it on Coursera, they can take it on any others. There are hundreds of them on the internet. And it's called Finance for Entrepreneurs. And so one of our main modules that goes through the whole theme is around finance and the mathematics of finance. And most of the people that are becoming entrepreneurs think they don't know math. The truth of the matter is, if they're bright enough to have gotten to the point here, they understand the principles of math. We just need to give them the examples.
Well, let's talk about those examples. And one example that intrigued me particularly, Alex, about your book was the example about compounding interest. And can you say a word or two about that and why people struggle with that?
Sure. I think I'd start by saying often in a student's mathematical journey, they feel like math is this endless barrage of discrete mathematical concepts that may not link together. And part of what the book tries to do is say, actually, we can connect everything back to addition. So to get to exponential relationships, I'd start with addition and the example I gave earlier, which is, let's say every hour I work, I add $7 more. $7 per hour, that's my wage. That's a linear relationship. And that's where linear functions come from, which is straight from proportional relationships, which is straight from addition. Even a first grader can add 7 plus 7 plus 7. All that we're doing in exponential functions is saying, instead of repeated addition, we're just going to have repeated multiplication. That's all an exponential function is. So instead of adding 7 plus 7 plus 7, each time I'm just multiplying 7 times 7 times 7. And that can grow quite large. 7 times 3 is 21, whereas 7 times 7 times 7 is 343. Then times 7 again is 2,401. Times 7 again, 16,807. The numbers just explode, which is where we get exponential dynamics like COVID from. And so I think to pull this back to compound interest, when you put your money in a simple bank account with simple interest, the money is growing linearly. It's just adding a little bit each year. But with compound interest, you are getting this repeated multiplication such that when you keep the money in a compound interest account for a long time, the money is multiplying. And I'd close by saying, if a 22-year-old puts $5,000 in an account with a 6% interest rate and they save it until retirement, that compound interest was going to leave them with $92,000 after 50 years. Whereas if they have it in a simple interest account, which just relies on linear relationships and addition, they'd end up with $15,000. So it's just a huge difference of compound interest, which is about repeated multiplication, and simple interest, which relies on addition.
And probably your best example in the book is the one with the king's coins. Do you want a penny every day, or do you want it, or $1 million up front?
Yes.
And students, you can't see that one. I mean, they just don't get it till they understand the principle of compound interest.
Yes.
Well, let's go beyond compounding a little bit even more. So a lot of students are confused about the stock market and about why they should invest or shouldn't invest in the stock market. Why should students think about that?
Well, we think they should. We're running a whole module in our program. They need to understand all of the terms of the stock market, what they don't. And they also need to be able to understand how to read and do an analytical analysis of stocks and companies. Most people don't know what is the return on an investment. What are you looking for? How long should you hold your money? When should you sell? All of those are based on the principles that Alex teaches in his book. We're very, very clear in adding this module this year, particularly with AI. And the person running the class has been very successful in the Bitcoin, and he's running the class through a simulation. And he gave each student $10,000 at the beginning of the class as he's been teaching it, and he shows a scorecard each week. Interestingly enough, 2 of our students are beating the S&P, but are also beating him. Now, will that continue as they go through? And at the end, he's the student that has the best results. He's going to hire them to work for him and give them a portfolio of money and share the profitable returns with them. So almost all of our entrepreneurs are taking the class. We didn't require it. It was a suggested addition because it meant they had to spend more time at the program. So.
Which is really interesting. Can we get just even simpler though? Why would somebody invest in the stock market as opposed to putting money in a simple savings account?
Well, if you know the answer to that, you'd be very rich. I don't know the answer to that, but I do know that the reason, I think it's certainly your risk profile. My book spends a lot of time talking about the entrepreneurial mindset of entrepreneurs, particularly women. And most entrepreneurs have a very high risk profile. So they're likely to take a risk in starting something, take a risk in taking investment money. So they're inclined to think that the stock market's good for them because they're watching it, because they all think they're going to get rich and their company's going to go IPO at a ridiculous valuation. On the other hand, if you have a lower risk profile, you have what we call calculated risk. And then you need Alex's skill set to understand how much risk you're willing to take. So when you look at somebody that does invest in the stock market, you're likely to find out that they have a high risk profile and not a lower risk profile. However, people with calculated risk are likely, if they're smart enough, to understand that they need to understand the principles behind it. But it has nothing to do with level of education. It is totally a risk, how much risk you're willing to take. I have a couple that they both are highly educated. One has a PhD in economics, and he's adverse to the stock market. The other one has an MBA, and she tends to be more likely to invest in the stock market.
Can I just build on that for a moment? I think something that I would say is, especially for younger people have a form of wealth that 90+% of humans who've ever lived are lacking, which is time. Statistically speaking, someone who's just graduated from college has a long runway of life ahead of them. And when you talk about compound interest in the stock market, time is one of the most powerful drivers of accumulated wealth that you can have, which folks who are older just don't have access to that form of wealth. And so when you think about the stock market and approximate 7% annual returns in the S&P 500 historically, if you have 50 to 60 years ahead of you and you can put money aside, that time is going to do wonders for your wealth over time. Whereas a simple interest account and a savings account, especially now with interest rates being what they are, that money just isn't going to grow nearly as much over time as the stock market. I'd close by saying that young people, like all of us, would benefit from a diversified portfolio where young people have to pay rent, they have to pay bills. They need some money in a simple interest account that they can access tomorrow. But if they can just put aside a small amount of money, even $10 to $50 to $100 a month, they can be disciplined and set that aside, that's going to grow so much over time because they have more time statistically than most of the rest of us.
Yep, I agree. And it's really funny because I'm past the young category, and now when I see the market, and I'm a risk taker, so I'm willing to take risk, and I call my financial advisor. I say, we should buy this stock, and she says, you're crazy, but I buy it anyway. But I do find that I'm more concerned about how much time I have left in the market. So that's a pro and a con. The good news is I probably have more than enough money that if the market drops, I'm keeping it in things that will let me live out at the level I'm living out for another 20 years. But if if the market stays low, then I want her to put it in things that are more stable and maybe make less, but I know I'm going to get a return, because if the market drops, I don't have 50 years for it to come back and make the 7% over time. So it depends on how much risk I'm willing to take. And I've said this money is what I call funny money. I'll risk with this money, but I won't risk with this money.
And how would you determine what somebody's risk level is? Or even better, how would you decide what your own risk level is?
There's lots of profiles that you can take. In my book, we used one called the Entrepreneurial Mindset Profile, and it has 12 attributes that it gives you a scale, if there's no right or wrong, but the scale marks you against highly successful entrepreneurs and highly successful corporate people, and it gives you your scale in comparison to that. It's a typical kind of profile that asks a bunch of questions, and then based on that. So you can take lots of those. That's not the only one. We use that as research, and we tested over 250 young entrepreneurs out of Penn, out of our business plan competition, and out of our incubator. And we tracked their profile at the beginning and at the end, and we found some very interesting results. Another conversation. But there are profiles that tell you. But you really know whether you're a risk taker or not. You know from a child in the beginning. How many kids, you watch your own children jump off the one will climb up on the cabinets and fearless and will jump down. The other will bring the stool, hold on, ask for your hand. So you know when you have a risk taker or a non-risk taker. And risk taker is a personality trait, so I really can't change it much over your lifetime, but I can make you more aware of it, so you're more likely to know when you should be taking a risk and you shouldn't, and your profile saying don't, but you know your intellectual side is saying, well, I can take this risk. It's very interesting because most corporate boards require men to have CEO risk insurance because men are more likely to jump out of an airplane than women on a skydive. And so while they do require, most big corporations require man or woman CEO to have CEO insurance, less women in smaller companies have CEO insurance.
That's really interesting.
Yeah.
Can we bring this to a high school student, let's say, or a college student? Let's assume that college student doesn't have thousands of dollars in the bank. They just have maybe hundreds of dollars in the bank. They have to finish school, and they have to maybe take out some loans and pay their rent, as you suggested, Alex. How can they develop some of these skills with very little money?
I'd start by saying that a lot of it is about developing habits. We may not have a lot of money right now, but we can develop a habit right now of just saying, I'm going to have an auto withdraw set up on my bank account for $5 a month or $5 a week or anything it is. So I don't even notice it. I'm passively investing. And later, my salary might go up, and then it's the same muscle. Instead of putting aside $5, I'm now putting aside $30 or $50 or $100. But I have worked on the self-discipline to set up that culture and that habit in myself. I think that is one of the best things that young people can do. One thing I'd add quickly is we've been talking a lot about the upside potential of the stock market and compound interest. But I think another thing on the reverse that can really handicap young people is not paying attention to things like credit card debt, which uses compound interest but in the other direction. The stock market is about 7% a year returns, whereas credit card interest rates, variable rates, can be 15 to 22% if you don't pay them back. And so I would just say that young people also have to be very attentive to how they're using credit cards and how that can work against them with compounding debt over time.
Yeah, and entrepreneurs suffer from this. I'm in the process of raising a debt fund for early stage entrepreneurs, because up till now, most successful entrepreneurs always have in the beginning, a short-term cash fall. They'll get their contract in the spring for education or for health care, and they don't have to get paid till September when the school starts using it or the university starts using it. So now they have the short-term cash thing. Most of them go to their credit cards, bad mistake. And then those that go to the loan sharks, they're not all loan sharks, but they charge a very high interest rate. So we're creating a debt fund that will charge lower interest rate than the credit card, and we're raising the funds, interestingly, from people, the entrepreneurs that have been successful and are now want something where they can have an impact and are willing to give back. So our financial structure isn't just we'll pay you interest. You charge me 15% to lend the money, and I'll charge you 18%. It's basically based on the fact that they want to have an impact, and so we're going to charge lower because they're not looking for the big return as an investor. They want a return, but they're happy with 5 or 6% return rather than 10% because now they have an impact, and they get a warrant to get stock. So if this company does successful, they can take their loan in a warrant, and we won't even get into what warrants are right now. But
Well, that's really interesting. But again, if we can simplify this just a tad, for a viewer who's thinking about very simple transactions, why couldn't a person simply walk to the bank and borrow some money for that 3-month gap?
First of all, they won't lend it to an early stage entrepreneur. You have no collateral, no reason to loan it. So most early stage entrepreneurs raise money from friends, fools, and family. So, and they raise a little bit of money, you know, $200,000. And so grandma gives them to them, or your mother or father, or you get them from a friend that has made a lot of money and wants to help you out. So they could go to a bank. They tend not to go to a bank because they can't get the money from a bank. They go to their credit card, and then friends, families, and fools, and then they go to a loan company, a private debt equity company. And I've watched several of my companies have to go to that, which is why I'm raising this $40 million debt fund. I've watched my companies have to pay somebody, you know, 18 or 20% interest, and they only needed, you know, $250,000 to get to the payment on the contract.
Who are the fools in your example?
I think there's a lot of fools that put money into investment. They do it because they want to get into the market. They see these companies getting started and they make a lot of money. So they become part of these angel funds. And they don't understand the math, and they don't understand enough about investment, but they see their friends doing it and they have a little bit of extra money. So yeah, I'll give you $25,000, and if I make money, fine. If I don't. So there's a lot of these angel groups. And for a lot of people, particularly I have a couple of them that are women that do it, they've made some money. They're not making a lot of money, but they're helping people and they're learning a lot about being an investor.
But let's go down that road a little bit more if we could. So if you did have an extra $25,000 and you wanted to invest in a friend's company, do you recommend or not recommend that you potentially do that?
Again, it's your risk profile. How much risk profile do you have? And as I said, I have a fund of funny money, and I use that to invest in early stage startups. I'm advising them. I'm a pretty good analyst of companies because I've been successful at it. If somebody came to me and said, tell me a company to invest in, I would probably tell them not to do that, because remember, in the venture world, 1 out of 10 companies are successful. You get a return on. So you've got to have a pool of these. And I invest in 2 or 3 a year, somewhere between $20,000 and $5,000 and $50,000. But I invest because I have a skill set, and I ask them to match my money. So if I put 25 in, I say, for my advice, and I want you to give me another $25,000 worth of equity. So I'm taking the risk, but I'm having a backup on the equity. And you know, I do pretty well. I'm not going to get rich, but I've done well on many companies. And so I think your answer to the question is, if you know somebody and you know the company and you feel good about it, then you should invest if you have a little bit of money. But it has to be part of a whole investment strategy, sort of, as you said, a diversified investment strategy. I don't only invest in startups, but I invest a pretty, you know, a significant amount of money to other people each year. But I can afford to do that, and I can afford to take the risk.
And I think one thing I'd add is we talk about risk profile, and I just want to bring back that time variable because it's unique to the younger people who we're representing here. If you have $25,000, if you can put it into the stock market and wait for a while, you're almost guaranteed to have a fairly spectacular return if you can wait. It's just like the marshmallow test from Walter Mischel in the 60s, where you get 1 marshmallow now, and if you wait 15 minutes, you're gonna get 2 marshmallows. And kids' ability to self-regulate predicted a lot of things about their future. And this is similar. It's your risk profile, but also when do you need the money? How much in a rush are you? Because if you have that money now and you can wait, you're almost guaranteed to have a lot later. Whereas if you say, I've got a high risk profile, I want to invest it now, and I want my friend's company to make me a lot of money within 3 years, it might work out, and it might not. It's just
Interestingly, young people today are watching the stock market. Maybe they're not having a lot of money in it, but they're more likely to think they saw their friend as an entrepreneur. My son started his career in Silicon Valley. His first startup he went public for a young kid, he did very well, and he was one of the first 100 employees. So he took a risk going to work, and he had gone to LSE to get his master's. And when he came back, he took this risk to go out to California and take a job with a startup. It was Yelp, did very well. He then he was there for 8 years. He was one of the first 100 employees. He transferred to another company, and he did it again, but he was willing to take that risk. He made money on the second company because they went public in a SPAC, and he was, by that point, smart enough to know that he could sell as soon as he could because SPACs were going to crash. So,
let's, if we can turn this to courses that students can take today. So let's say somebody's watching this. What courses can they take right now at a high school or a college? Some names of courses that you think would be best to help them understand this orbit.
Well, I know, and I've taught at the University of Pennsylvania and work with the business school at Hopkins. I don't see a whole lot of courses for anybody that's not in the business school or in that space to take. Although I do see a lot of courses online that people can take separate from their university. So unless you're in a business track, there's sometimes a school offer financial literacy courses. And I've funded, not me personally, but my incubators have funded financial literacy startups. There's too many of them, and they're not doing what needs to be done. So very few of them have succeeded. Schwab funded one for a lot of money. It did okay for a while, but in the end, it couldn't make enough people taking it. So the answer to your question is there's not a lot of choices, unless you go to the business school and take a course, unless you're encouraged to take a course. Now, many universities now in the freshman year are requiring, the same way they required a social, they're often giving a financial literacy class, not a class, but one of the things they do in orientation kind of thing. Many freshmen are getting that. Not a lot, but some.
And I fully echo this idea that there aren't enough. And what I find frustrating is, and the reason I wrote the book, is that in math classes from K through 12th grade, we go out of our way to make contrived real-world math examples of, you have 47 bananas and I have 16 oranges and we have 4 bags. How might we divide them? Or we have a bacteria that's multiplying. And it's like, the kids don't care about these examples, and a lot of them aren't real. We already have finance that everyone needs to know. Why wouldn't we teach math in that way? So to me, I would like for math and personal finance to be infused all the way from kindergarten. When you're learning to count and add, why not practice with money? And so to me, we don't have enough courses about personal finance, but we have plenty of courses about math. And I would like for the math to better echo or mirror personal finance. I'd close by saying at the high school level, a lot of schools offer personal finance or financial algebra to seniors, but that's often the non-honors, non-calculus or pre-calculus track class. So it's often for students who struggled in math, and then they're learning this really important content, but it's too late because they don't often have the prerequisite math skills to even access the course. So I don't think there are enough classes in K through 12, and I think we would serve kids better by infusing personal finance throughout.
Well, let's hope we can do that. Thank you both for your time today.
Thank you.
Yes.
If you would like additional information about personal finance, please reference both of the great books. Actually, if you can hold up the books that we are talking about, Counting on Yourself and InnovateHERs. And if you have a question that you'd like to send to me at the show, please go ahead and send me an email at highereducationtoday@topcolleges.com. And thank you for watching. We will continue to bring you quality discussions about important matters in today's college and university world. I'm Steven Roy Goodman, and you've been watching Higher Education Today.